$936 billion. That is not just a number. That's the volume of commercial loans due for repayment or refinancing in 2026. This is a fact from a Talinvest Capital report published in November 2025. Not speculation, not a forecast, reality. Now, let's debunk the lie the crowd has latched onto. The stabilization of the commercial real estate market, the recovery from the chaos of 2023 to 2025. Analysts from J.P. Morgan insist the market is well positioned for success in 2026, with increased capital and strong market fundamentals. Deloitte records a 13% increase in new loan volume compared to the end of 2024 and a 90% increase compared to the same period last year. CNBC is broadcasting a year of stabilization, where a slower economy and higher unemployment will supposedly lead to a gradual recovery. Cushman & Wakefield goes further, a shift from resilience to optimism, with a 50% probability of continued economic expansion and easing inflation. The NAR, the National Association of Realtors, lists the issues but concludes with an optimistic note. Economic uncertainty, tech shifts, but opportunities ahead. It sounds like a mantra, comforting, but here's an anomaly that hits you in the gut. CMBS, Commercial Mortgage-Backed Securities. Packages of mortgages on commercial real estate securitized and sold to investors. $100 billion of this matures in 2026. More than half, exactly $57.7 billion, is likely to default at maturity. Another $9.9 billion is in high risk. Data from Commercial Property Executive, current as of the end of 2025. Why is this happening? Rates have risen from 0 to 5%. Refinancing is becoming impossible for many. Office vacancies are double digits in New York and San Francisco. Property prices have already fallen by 9% in 2025, on top of 13% in previous years. In Europe, this is the bottom of the decade. Banks, including major players like Wells Fargo, are employing the extend and pretend tactic, extending maturities, pretending the problem doesn't exist just to avoid immediate losses. But this is a stay of execution. The reality? Delinquency rates are rising steadily. Non-performing loans are piling up on balance sheets. This isn't a random glitch in a well-oiled system. It's a deliberate reboot. The system is being purged of accumulated ballast. Debt taken on during the era of cheap money from the Fed has now turned into toxic assets. Ordinary people with their savings in REITs will feel the blow first. Retirement portfolios, IRAs, 401ks, they are all infected with CRE debt, minus 20 to 30% in the worst-case scenario. The crowd of hamsters, blindly believing in rebounds and listening to optimistic forecasts, doesn't see it. But you are here. You see the truth. This is the beginning of the end of the current cycle, a reset where the weak are reset.
History is a mirror, not just a lesson humanity ignores again and again. It's inexorable proof that the mechanisms repeat themselves. Take the closest parallel, the 2008 global financial crisis. It wasn't just subprime residential mortgages that suffered. Commercial real estate suffered secondarily, but with devastating force. The mechanisms are identical to those of today. Back then, the maturity wall was colossal. About $3 trillion in mortgages taken out at low rates during the 2000s boom came to maturity in 2008 and 2009. Rates rose sharply after the dot-com bubble and 9/11. The credit crunch, the squeeze on lending hit. Banks like Bear Stearns and Lehman Brothers held balance sheets overflowing with toxic assets. Office vacancies soared to 20%. Construction stalled for years. Commercial real estate prices plummeted by 40% on average. The Federal Reserve poured trillions into bailout programs, saving large institutions, but not ordinary people. Millions lost their jobs, homes, and savings. The economy slid into a deep recession for several years. Now, consider the parallels. High rates from the Fed from near 0 to 5%, similar to the post-2001 boom. The 2020 pandemic left a legacy of empty offices, just as the 2008 crisis left unfinished residential projects. Remote work has become permanent, just as the shift to online banking followed the crash. Global factors? China was a member of the WTO back then, sparking growth but creating imbalances. Now, trade wars and tariffs on steel and timber are disrupting global supply chains. Corporations are cutting office space. Amazon, Google, Microsoft, similar to the tech layoffs of 2008. Regulators are putting pressure on capital reserves, just as they did with the Sarbanes-Oxley reforms. Liquidity is shrinking. In 2008, small and regional banks were the first to collapse. Now, the same thing. They hold 70% of assets in CRE. History shows when the maturity wall meets high rates, falling demand, and oversupply, a collapse is inevitable. Not just falling prices, a chain reaction, recession spreads, unemployment spikes, loss of generational wealth for the middle class, while the elite, the hedge funds, buy up assets at rock bottom for pennies. This is not a coincidence, it's a pattern rooted in centuries. Recall the South Sea bubble of 1720 in England. Speculation led to a real estate collapse when the bubble burst. Debt, hype, reality. Or the Great Depression of 1929, an over-leveraged market led to a 40% drop in house prices. Banks failed. People were on the streets. The mechanisms are the same. Debt accumulates in good times and bursts in bad. 2026 is a direct echo of 2008, proof of the cyclical nature of the system. And the next step? Not salvation, collapse, because governments are already overburdened with debt. History doesn't teach, it predicts.
Now, an audit of the mechanism. Let's break down how this trap works. Let's follow the money, step by step. Commercial real estate isn't just bricks, mortar, and rent. It's a debt pyramid. Loans were taken out during the Fed's zero interest rate era, 2010 to 2020. The analogy is simple, like a house of cards. The bottom cards, low loan payments. The top cards, stable rent from tenants. But the winds of change, the pandemic, inflation, high rates, are collapsing the structure. Let's break it down by sector for clarity. Offices are the main affected area. Vacancies have reached 20% in key markets like New York and San Francisco. Hybrid work has become the norm. Corporations are cutting space. Amazon has cut thousands of square meters. Google is following suit. Net operating income, NOI, the net income from operations after expenses, is falling sharply. Cap rates, the capitalization ratio, a measure of risk, have risen from 4 to 7%. The basic formula is NOI divided by the cap rate yields the value of the property. The result? A 40% depreciation. Instead of profit, money is spent on maintenance, taxes, and insurance. Losses from extreme weather events, floods, hurricanes, reached $380 billion in 2023, with insurance premiums rising by 20 to 50%. Refinancing old loans? At the current 5 to 6% rate, payments jump by 75 to 100%. Banks, large ones like JP Morgan and Wells Fargo, hold these loans on their balance sheets. Non-performing loans, NPLs, loans without regular payments, are growing. Delinquency in CMBS, securitized packages, will spike in 2025. The retail sector is under constant pressure. The shift to online shopping has accelerated. Stores are emptying. Malls are distressed. Industrial, warehouses, and logistics suffers from oversupply. New deliveries are up 4.5% in 2025, but demand falls with the economic slowdown and disrupted supply chains from China. Multifamily apartment buildings are holding up better, but the affordability crisis is biting. Half of renters are burdened, spending over 30% of their income on rent. 400,000 new units are planned for 2026, adding pressure. Construction overall is negative. Banks tighten standards. Lenders are stricter, at 9%. Regulators, the FDIC, the OCC, are putting pressure, increasing loan loss provisions, building reserves. Liquidity, cash availability, is freezing. New loans are rare. Borrowers are trapped. Restructure or face foreclosure. Conversion of offices into residential? Analogy like converting a tanker to a yacht. It costs billions. Zoning issues, time-consuming. It is not scalable. Globally, Europe is in distress, the peak of a decade. UK prices are down 20%. China's property bubble influences global supply. Tariffs on steel and lumber add costs. Immigration policies reduce the labor pool. Projects are delayed, margins are squeezed. Politics acts as poison. The 2024 elections amplified tariffs and restrictions. No major changes in 1031 exchange, tax deferrals, but the damage from uncertainty is done. Banks play a dual role. Victims holding the bomb of maturing debts. Criminals, they issued risky loans in boom times. Small banks are most vulnerable. 70% of their assets are in CRE. They fail first. FDIC insurance limits $250K per deposit. Larger sums risk a bail-in, where deposits convert to equity. This is a full audit. Money flows from owners to lenders, from the masses to the elite. The trap snaps shut. Nuances. Some sectors like healthcare CRE remain resilient, but overall, contagion spreads. Edge cases. If rates drop suddenly, the impact might be softer, but sticky inflation prevents this. Related, pension funds hold 10 to 15% in CRE. The implications are wide.
Forecast for 2026 to 2027. Logical. Fatalistic. Based on numbers, not hope. The trend? Deepening distress, leading to a full crash. The maturity wall peaks, $936 billion in 2026, then $1.15 trillion in 2027. That is over $2 trillion in just 3 years. Half of CMBS, commercial mortgage-backed securities, are likely to default. Banks will initiate forced sales, a wave of liquidations. Prices will drop another 20 to 30% in offices and retail. Industrial vacancy peaks in mid-2026. Multifamily rent growth slows to 3 or 4%, higher in the Midwest, lower in markets like Miami and Austin. The economy? GDP growth will be minimal, 1 to 2%. Inflation remains sticky at 2 to 3%. The Fed holds rates high, between 5.5 and 6.5%. Variable rate mortgages will hit the hardest. Recession probability? 50%. Job losses are coming. Construction, real estate services, healthcare, and transportation will be under pressure as demand fades. Consumer spending falls as unemployment rises to 6%. Global contagion spreads. Europe enters further distress, a decade-long peak. China's slowdown exacerbates trade issues. Investors continue to shrink their allocations. Liquidity evaporates. For the average person, the world looks bleak. Empty office buildings in downtown areas becoming ghost towns. Unemployment spikes, families struggle. Pensions and investments linked to CRE funds prepare for a 10 to 15% drop in portfolio value. REITs and global real estate ETFs, potential 25% loss. Small businesses, retailers, and service providers will face a bankruptcy wave. Evictions in multifamily housing will rise. Homeowners feel an indirect hit as the economy drags the residential market down. Deposits over $250,000 at risk in a bail-in if banks fail. The crowd stands in queues for unemployment aid and food stamps. Meanwhile, the elite, private equity, and hedge funds buy distressed properties for cheap, positioning for the rebound. A rebound? Possible in late 2027, but only after the pain. Nuances. If the Fed cuts rates aggressively, we might see a softer landing, but political whiplash from tariffs worsens costs. Extreme weather adds insurance losses. This is not optimistic. This is harsh reality. The world is getting tougher, unforgiving.
News is noise, ephemeral, manipulative. Numbers are the eternal truth, silent but unyielding. The commercial real estate collapse of 2025 and 2026 is not a random anomaly. It is a pattern woven through centuries of economic cycles. The capitalist system is cyclical. It accumulates deaths in booms and resets in busts, shedding the weak. The crowd, blinded by optimistic lies of stabilization and recovery, ignores the facts. They ignore the wall of maturity, high rates, persistent vacancies. But the evidence in numbers, it is undeniable. History serves as a mirror, echoes of 2008, 1929, 1720. The mechanism has been audited. The debt trap is closing. The prognosis is inevitable. Pain, recession, a massive transfer of wealth. For ordinary people, the world becomes harsher. Jobs lost, savings eroded, dreams shattered. But in this reset, truth endures. Numbers remember every transaction, every default. The silent ledger records everything. Illusions of perpetual growth are broken. Reality remains cold and immutable.